Welcome to the Broken Pie Chart Podcast, episode 219. I'm your host, Derek Moore, and with me once again, my semi-permanent co-host, back after an absence for the week, Jay Pestrichelli, CEO of Zega Financial. Jay, how you doing?
Good, Derek. I was going through withdrawal. I needed to come back to the Broken Pie Chart podcast. So thank you for having me back.
Well, of course, you are the semi-permanent co-host, whatever that means. Means you're around a lot most of the time. You know, sometimes we have mics, sometimes we have some.
It's going on my business card.
I think it should, as it should. Well, Jay, we have a lot to talk about this week, and we're going to talk a little dividends. And people might say, well, okay, what are you going to really tell us about dividends? But I think there's a misunderstanding about some aspects of dividends we can kind of go over. We have to talk about what the Fed just did. And, you know, you missed last week, but we sort of started a new segment where I've been asking ChatGPT some investment questions. And I asked it some questions about the Fed, so we'll kind of go over those. But Jay, first off, let's talk a little bit about dividends. And I've noticed that there's actually some people making videos. There seems like a lot of millennials or younger investors that are, I wouldn't say suddenly interested in dividends, but I think it's interesting. I haven't seen this much content. And I'm going to go over a couple things, Jay, really quick. And there are going to be some people in the audience who say, yeah, I know what this stuff is, but not everybody does. Not everybody does. So,
and I'll tell you, Derek, that the dividend landscaping is changing, right? I mean, for a lot of reasons and how it applies to us without getting too specific. But I think it's a really relevant topic right now. So I'm glad you brought it up.
So first things first, whenever you have a dividend, and I'm going to use BIL, which is a State Street ETF. It's the Bloomberg 1 to 3 month T-bill ETF. So symbol BIL. It's not a recommendation, by the way, but look, it's 1 to 3 month T-bills. And when the things that are pertinent for a dividend are, you have an X date, a record date, a payable date, and then you have the distribution amount. And the distribution could be just a dividend or it could be a return of capital gains. We'll sort of get to that. So using BIL, the X date was May 1st. What does that mean? That means that's the first date that a stock trades without the dividend, meaning whatever the dividend is, it should all else equal. And of course, you know, stocks can go up or down by supply and demand, but all else equal, the stock should be reduced by the amount of the dividend. You have to, if you want the dividend, you would have to own it the trading day before the X date because it starts trading without the dividend. You don't get the dividend if you buy it on X date. It's already accounting for that. There's the record date. The record date usually is, you know, like a day after the dividend. So in this case, 5/1 was X date, 5/2 was the record date. And it's a little bit archaic, the record date, but it's just when the company would determine who is on record as a shareholder to pay dividends, send you a proxy statement to vote on boards, all things like that.
Yeah, Derek, a little bit of the record date, little color there. It also has to do with settlement, right? So, you've got the X date and then the record date. The record date means if you bought it the day before the X date, you settle on the record. So it's one of those things that gives them the official list of who they're going to send the dividend to, right? So because stocks are at that T+2 settlement. So there's a little bit of, you're right, it's a little archaic and it's a little bit of kind of clearing mechanics, which I know you don't want to go into depth on this, but I think that's why that date is important.
That's right. And yeah, let's do an hour about settlements and clearing conversion.
Oh my God.
That will get everybody jacked up, right? No, I'm sure there is a podcast that addresses that, and those people are very interested in it. But
because people do time it, right? People do try to make sure they're in, a stock or an ETF. They want to know, when do I have to be in to get the dividend, right? Like that's some, that matters.
Well, that's right. And then of course, so it goes ex dividend. So the stock is reduced by the amount of the dividend, all else equal. And then you have the payable date. So in this example, 5/1 was the X date. The payable date is 5/5, which is today as we're recording this. And their dividend was 0.353155 cents per share. So What's interesting though, Jay, is the dividend goes X, and then you don't get the dividend for a couple days later. So I think as we think about, and this is one of the misunderstandings I think uh, with how total return works with a stock. Like Jay, let's say XYZ stock. Here, I'll set this up for you. XYZ stock is trading at 20. It pays a $2 dividend. Awesome. And on X date, though, the stock gets reduced to $18. And we assume that there's no other news or anything else that causes stocks can the stock could open at 20, even though it paid a $2 dividend if there's enough buying. But let's just go with our example. So, Jay, it's like, okay, my stock goes down to 18. It looks like I lost $2. And part of the reason is that you got to wait for the dividend to come back on the account. So, like, your account's going to show like it went down, all else equal, if, the stock doesn't change, you don't have anything else in there, right?
Yeah, that's right. Because all you see is the number of shares times the value of, in your case, this XYZ, which is at $18. If you had 100 shares, the day before X, you were worth 2,000, and then the day after on the record date, or even 2 days after, it looks like you only have 1,800. But it's because you have this $200 of cash coming your way, and that is usually about a week. Bill is doing it a little faster, but usually it's about a week to you get your cash versus the decline in price from the X date.
The other thing too is, so most price charts, and I think our audience knows this, but well, maybe they don't. Maybe there's some folks who don't. A price chart. So if you pull up your favorite broker, or maybe not even your favorite broker, maybe even one you hate, I don't know. But anyway, it's the price chart.
Pull up Yahoo. How's that sound?
Yeah, Yahoo, whatever. So you pull it up and it's just the price. What do I mean by that? Well, in our example, the stock goes from 20 to 18. The price chart will show it went down by 10%. $2 is 10% of 20, gets you to 18. However, the total return, including dividends, you're actually flat. It's 0%. And Jay, as you just explained, sometimes, it's a week between when you get your dividend and when X. And so I think this is one of the misunderstandings sometimes. And I'll be honest with you, Jay, I wonder why more charting programs don't allow for, hey, let me just click on total return. Because that's really a representation of what you as an investor would have actually realized, right?
Yes. Well, yeah. When you think about the total return, I mean the amount you get back from your investment. In your example, if that stock stayed at 20 and then paid the $2 dividend and stayed at 18, and then you got your $2 a week later, your return would be, gain loss would be zero. You just happen to now have 1,800 of stock and 200 of cash versus before having 2,000 of the stock. And so in that scenario, you're right. You didn't lose 10%. Your stock value went down 10%, but your cash value went up by that $200. And so, it's one of those things that gets a little complicated because now do that a few times, right? Let's say the next month there's another $2 dividend and the price doesn't change again, right? Now your value is down to $1,600, but you have $400 of cash. So you're right. It appears like stocks and ETFs that pay high dividends appear to trend lower. Some bond funds appear to trend lower because their price might be lower, but the total return hasn't changed. And I think it's really important for people to understand when you go, hey, why is this ETF down or why is this stock down? You have to look at the total return to know, is it down or not? I mentioned Yahoo Finance. There is a convenient way in the historical prices of, say, a platform like Yahoo Finance, where they adjust the share price for the dividend. And so don't look at the trading price each day. Look at the adjusted price when you're trying to determine the actual return of your portfolio, because it takes into consideration all the dividends and when they occurred, and it adjusts the price so that you can see the impact of the dividend and know, is a stock or an ETF up or down.
I'm glad you made that point too, is the sort of over time, and especially the higher the dividend something is paying, that chasm between price return and total return, including the dividends, that's only going to spread, further and further apart. And you mentioned some bond ETFs, something like the high yield ETF from State Street as well, SJNK or SRLN, which is their senior loan. Those, I think, those dividend amounts are over time. I mean, those are bond funds. Bonds are designed to pay out cash flows to investors. So you'll see that. And if you just ran a price return only, what's interesting though, Jay, is, if I pull up a chart of, let's say Apple, why Apple? I don't know, but we know they've split. Or Tesla. Didn't Tesla do like a 7 or 8 to 1, something
Yeah,
like
a few
that, 9 to
times.
1?
So yep.
Yeah. Could you imagine if a price chart didn't adjust for splits? Meaning, imagine the stock is at 1,000, it does a 10 for 1 split. So you have the same number of shares, nothing's changed, or you have 10 times the shares, but now the price goes from 1,000 to 100. Well, if 2 weeks ago the price was 1,010, today on 10 to 1, it would be 101. But can you imagine you had a price chart that just went from 1,000 to 100? You'd be like, what happened to this company? What are they doing? This company knows their management team should be fired. No, it was a 10 for 1 split.
They lost 90% in a day. What happened, right? 90% down, right?
Yeah, it's like, and I get it. I mean, a dividend's a little bit different, and you could make some assumptions about reinvesting and things like that. But no, I agree. By the way, it's Jay, I don't know if you've seen this, but more and more, and I think younger investors, and by younger, so how old are millennials right now, Jay? Do we know that?
Yeah, 30s, 40s.
And what's the I guess I could ask ChatGPT this. That's going to be a segment
There
later.
you go. Sure, ask it. Yes.
Yeah, I could ask it. But no, I mean, I think millennials and then younger. What I'm seeing, Jay, that's interesting on dividends. When we think about dividends, are
Oh, that is Gen Z, Derek. In case you're wondering, the one younger than millennials, it's Gen Z. Your son is a Gen Z.
Gen Z. Okay, all right. We're Gen X, right?
We are, yes.
We're the older Gen Xers, right? I think.
Yeah, I don't know. We're somewhere in the Gen X, in the X range, but I don't know. Yeah, maybe. Yeah, it's probably about right.
All right.
I will speak for yourself, old man.
Hey, wait a second.
I
Let's get back on track though. So my point is, like, you think about dividends are usually people who want income, meaning they're retired and they want a bunch of stocks that pay out dividends. They want cash flows. But Jay, what's really interesting is these younger investors, they're actually doing some interesting things. So I watched some videos. Yeah, I did it, Jay. I went onto YouTube and I went down this rabbit hole where these people are posting videos. And what they're doing is they're actually estimating their annual income in dividends, and then they're converting it to an hourly rate. In fact, there's a few apps that are out there that will scrape a portfolio and they'll estimate your dividends and they'll. So imagine you looked at a portfolio and you're going to get paid $20,800 in the next year in dividends. Why 20,800? Well, because if you take 52 weeks times 40 hours a week, it's 2,080. So a quick way to convert an annual salary to an hourly is take whatever it is divided by 2080. So $20,800 is actually, in theory, the way that they were calculating this, you're earning $10 an hour. So it's just really interesting. And it reminds me of, it's really about cash flows. And other people, Jay, they actually put in, there's a bunch of apps, maybe, but I don't want to mention any by name, but they put it in and they're like, okay, my goal is to pay off my cell phone. My goal is to this. And so what they do is they have these dividends that come out and it shows, am I covering my cell phone? Is it covering my car payment? Okay, it's almost covering this other thing. But I think it's kind of fascinating. There's this whole group that are just loving dividends, Jay. Are you aware of this renaissance, I guess?
I'm definitely aware of it. We manage some funds that are dividend focused. We won't go into details on that. And I'm absolutely aware of the universe of social media content that is talking about how to create, I'm making air quotes, passive income through a dividend portfolio to help pay your bills. Now, I think that's fine and all. I mean, there's a whole different aspect of it with risk and the changing of the underlying price, right? A stock that pays 3% dividend when it's $100 and still pay, that's $3, but then it pays 3% when it's $50, it's only a buck 50, right? So like there's some piece about that it feels wrong to me to ignore the market movement of the underlying asset that is paying the dividend. It's not always like bonds, right? But this concept isn't foreign, right? People, when you're buying a bond and you expect payments, that's part of it, right? That's all. I mean, it's all kind of linked, right, in one way or another. But I do love that dividends are becoming more and more interesting to talk about, and there's a lot more ways to generate dividends and earn dividends out in the market now, especially with things like actively managed funds. And so one of the things, Derek, that I always think about though when it comes to dividends, and when I talk to a real active dividend investor, right, they will tell you if you're not reinvesting the dividends, you're just, you're not in a growth mode. Like if you're going to take the dividends to pay for your cell phone, fine. What do you do when your cell phone's over, right? When you're done paying for that. In that scenario, what are you going to do? And the answer that a lot of really, I'm going to call hardcore, because there is this universe and community of hardcore dividend investors that will talk about reinvesting the dividends, right? Increasing your share count. And, people will know it as DRIP, dividend reinvestment plans. Your brokers will sometimes do it for you automatically. Maybe you have to do it. But I think, when you talk about dividends as a means of growth, that's what I think about when I think about dividends versus kind of the, this, hey, use dividends to pay for something. But that's, and I'm going to pause there, but I want to lead you into a point that you have made multiple times of what percentage returns for the S&P are related to reinvesting dividends. Do you remember that number off the top of your head? You've referenced it in the past.
Yeah. So from memory, it's not necessarily so. A total return assumes that you reinvest dividends, but then if you look at a decade like the '70s, most of the return in the S&P that decade was due to dividends, meaning your price might have gone up by 2%, and if you got a 5% annual dividend, well, now your total return is 7. I'm using like back of the envelope stuff. So there are times in the market where the dividends really drive a high percentage of the total return. In the 2000s or say the 2010s, most of the return was not from dividends; it was from price. But Jay, I think when I look at this, and you make a good point, because for younger investors, I think one of the benefits is maybe reinvesting dividends and getting that growth. Like I look at income sometimes as saying that's for later on, but I'm willing to go back and forth. But I don't you think, Jay? Like I think it's a toss up. Yes, you may have some dividends that are paying out, but really you could play the let me try and reinvest them and get more shares, right?
I mean, to me, that seems like especially on maybe like if you're willing to be in the underlying stock or ETF, reinvesting is a way to kind of add to your exposure to the upside. And it's while using the kickoff of cash from the underlying itself to do that. So, yeah, I mean that's where usually a lot of kind of like I said, the hardcore dividend investors will say you got to drip, you got to reinvest those proceeds.
What's nice too, Jay, is that like with us, when the separately managed accounts that we manage, and because commissions are zero, it used to be if you did the drip, meaning direct, automatically it
Yeah,
would get paid a
dividend
dividend,
reinvestment
and
plans. Yep.
dividend. Thank you, dividend.
Yeah,
But
you're
now with
solid.
no
I got
commissions,
you. I got you, man. You always
yeah,
get me.
it is what it is.
You always
Whatever
you
it's
always
called,
salvage.
they should
Help me.
maybe a new name. Yeah, but now with no commissions, I mean, we do like as we rebalance accounts. I mean, dividends that come in, it's part of those get reinvested. So, but I think also, Jay, and you've done some work on this, the idea that as dividends are coming in, if you reinvest them, we always think about, oh, what do you need for a compounded growth rate to double your money over a decade? And of course, if you get 7.2% annualized, in theory, no cash in, no cash out, you'll double your money in 10 years. But you've done some work on this, Jay, where like if you reinvest dividends, it depends on the rate, but how many years to double the amount of shares? Do you want to share that with us?
Yeah, like let's say you've got a fairly let's just say you've got a portfolio that's paying you 5%, or you have an ETF, or you have a stock that's paying you a 5% dividend, right? And let's just say it's paying you monthly. Maybe it's like an ETF, like you said, like some of the high yield ETFs, right? Maybe like an HYG or JNK or something like that, right? So those at a 5% rate, if you wanted to double your shares, and that's if you just kind of reinvested each month, you would end up doubling your shares in just under 14 years, 167 months. You would end up having double the number of shares that you started with. And you may say, geez, 160 months, like 14 years, and I have double the shares. That I can see why some people be like, I'd rather just kind of take that, who knows what they're going to do with that, right? But having doubling your size of your position, is obviously interesting because you're making double at that point on the actual dollars being distributed to you than when you started. But let's say you wanted to get a little more aggressive in your underlying holdings, and you had an ETF out there that was paying you, I don't know, let's say like 25%, right? In that scenario, if that was paying you monthly, that's just 2.8 years you'd end up doubling your share count. And if you happen to find an ETF that's paying 40%, and in that scenario, you're doubling your shares in just 1.8 years. So in under 2 years, if you can find an ETF, or there's not, I don't know of any, maybe some REITs, Derek, that might be paying you that. I don't know. I'm not recommending you go out and finding the highest yielding stocks. There's usually a problem. But there are some ETFs that are designed to kick out high yields. If you can find one that kicks out an annualized yield of 40%, which is 3.3% a month, you would end up doubling your shares in about 1.8 years. So that kind of paints an interesting picture on why dividend reinvestment could be interesting for those willing to take a more aggressive stance in their portfolio for the higher yield.
Yeah, and I'll just say too on we're thinking about those numbers, and you're assuming it doesn't cost you anything to reinvest, and that also sort of makes some assumptions probably on the underlying price of the stock or the ETF that you're going into. And I guess it assumes you're getting I think you said monthly dividends, right? So if you do that. But yeah, I mean, I think it's interesting because on one side you're trying to say, hey, I'm going to build up my portfolio. I'm going to focus on dividends and treat this as almost like income, like a salary. And the other side says, if you're younger, you want to be reinvesting dividends and you want to be really focusing on growing the portfolio and not necessarily siphoning cash off the portfolio. It's kind of like in a business, like on Shark Tank, if you have to pay royalties, they always say, I'm siphoning cash when instead I could be reinvesting back in the business. So it's just two ways to look at it. But I think I don't know that I've really heard of the reinvesting the dividends time to double ever really discussed that much. I don't know if you remember that over the last 20, 30 years, right?
Well, it wasn't really interesting before when it's like, oh, you're getting 3% or you're getting 2% on the S&P. It was like, great. When I'm 90, I'll double my shares, right? But I'm joking about that. But like I said, there's products and tools out there today that make this a much more interesting concept and approach, right? So for growth of your underlying position in a dividend portfolio, is kind of can be maybe kind of self-sustaining and help you increase exposure over time without even kind of putting money back into the portfolio. And I think you and I would always recommend regular deposits, regular pay yourself, all of those things that go along when we have talks with advisor clients that are always important. But using your underlying holdings to do something like reinvesting dividends is definitely an interesting approach. And it is, I'm not going to say it's new, but it's just kind of, like you said, it's just not something that we've seen a lot, 5, 10, 15, 20 years ago, but it's definitely becoming a much hotter topic now.
What's kind of awesome to think about too, you and I both went through 2001, 2000, which was 2001, 2000, 2001, 2002, when a lot of people lost their jobs, 2008, 2009. And it is kind of interesting if you think, maybe somebody has a portfolio and let's say they're an investor who's really focused on dividends, like they could reinvest it and if their circumstances could change, of course they could sell some shares to cover expenses. But that's just an interesting way of looking at it. They could turn on reinvestment or turn it off if they needed the cash flows. I mean, look, that's what retirees do. Retirees, a lot of them are looking for income. And the cool thing too, like I was thinking about this the other day, there's probably a level where you've acquired enough wealth that, let's just use 5% or 7%, whatever it is, the dividend, where your dividend stream is probably more than your income for most of your years if you've built wealth. It's kind of an interesting thing to think about.
Sure.
Like think of somebody with $1 million. If you have 5%, portfolio is kicking off 5%, that's 50,000 a year. Probably more than you made when you started out. But it's kind of interesting. Last thing I just wanted to touch on, not all, so companies pay dividends, but Jay, some funds pay out capital gains. Usually, we saw this with mutual funds more. With ETFs, it works a little bit differently, but that's just where it's a distribution at the end, usually at the end of the year. And it's if the fund sells assets and they have capital gains. I won't even mention like MLPs and K1s. That will put the other half of the audience to sleep, but they can pay cap gains out as well.
Yeah, I was going to say you can get a little complicated here when it comes to the tax treatment of those dividends. They are usually taxed, right? And they're taxed as short term. Depends, but normally, right? So it's just something that you want to make sure you're aware of what the tax treatment is on those dividends. For those, we see folks that, for those higher end dividend payers, they throw them in a tax deferred account instead of a taxable account. Of course, in that scenario, you're not pulling the money out to pay for your cell phone in the example that you just said. But you're right. I think the tax consequences of dividends definitely something to pay attention to.
Yeah, and they could be qualified, non-qualified. Well, let's just not talk about taxes, Jay. We'll leave that for somebody else.
You brought it up.
I got to put a bunch of disclaimers. No, I know. No, look, taxes should be part of everyone's.
You're right.
Calculus. But all right, I want to switch to our old friend Jay. You know him, you love him, Jay Powell. He was on stage again, doing some things with interest rates, and last week I asked ChatGPT some questions. I'm going to ask ChatGPT about Jay Powell, or specifically, I mean, first of all, they pretty much in the language seem to indicate they're done now. Although Jay Powell, I think, is still reticent to say anything about cutting. And let me just start here broadly before I get to my ChatGPT prompts that I've asked them about the Fed. Is like, if they have to cut, doesn't that mean that something's wrong? Doesn't that mean that the market isn't doing well? Like, I know a lot of people are like, oh, we think they're going to cut later in the year. We want them to cut. But why would they cut if everything's going well? I don't know. Jay, any thoughts on that?
First of all, I didn't interpret him saying anything about cutting. I think he set the expectation that the rate of rate increases may stop or slow, but I don't think he was hinting at all about any rate cuts. Like, I think he made it pretty clear, like, don't expect us to cut at any time soon. But to your point, so I just want to say that first, right? There was no hint out of him that cuts are on the way.
Oh, no. And the last meeting, he even said, we're not cutting. He actually gave a pretty terse answer to a reporter. We're not cutting. This meeting, yeah, not as much.
Yeah, but so let's take the scenario where they had to cut. So if they did cut, there's two possibilities. The one is that things are so good they could ease up a little bit. But I don't think that's he's told us that's not happening. If things are good, by the way, he personally has said he doesn't feel we're going to have a recession, right? That wasn't his feeling. So he's saying he's not going to cut even if we don't have a recession. But if he had to, if the Fed had to cut, it would have to be a pretty bad situation where now they needed to stimulate the economy and prevent a deeper, I'm going to say a deep recession, and that they're not causing damage, right, to the market, just where they have to kind of bail out the market, right? They have to come back with the quote unquote Fed put, meaning the Fed is in the mood now to protect capital markets. Right now, they're trying to slow the economy. So, like, I'm with you, Derek. Like, I think he's made it pretty clear that he's not going to cut, but they can always be forced to if there was some sort of an economic, I'm not going to say catastrophe, but significant downturn to the economy.
Like a bunch of regional banks failing?
Nope, I don't think he
Like
cares
if that
about
were to
that.
happen?
No, I don't think he. I think he's fine with that. I don't think that's it. I think I don't think he would consider that enough of a problem to have to cut at this point. I mean, he's pretty much like meh. He's blowing off. We had now 5 regional banks that got into serious trouble after last week, right? PacWest. I don't know if they actually failed or they're looking for a restructure, but strategic options is what they call it when they're trying to figure out. I guess we'll find something out of it.
That sounds dubious. I know nothing about PacWest's balance sheet, by the way, but I'm saying that sarcastically.
They're exploring strategic options. Tells me things aren't great. So that's number 5. And I don't believe that is going to be the thing that impacts the Federal Reserve to lower rates. I think it's got to be much more severe than that before they start coming down. I mean, look, like, what if inflation dropped to 1% and stayed down there? Yeah, I bet they would do it. I bet they would cut rates. But short of that, right now in 2023, I don't think you should expect it.
They wouldn't necessarily cut rates just to do it because it sort of takes away some of their ammo. And, remember when rates were really, really low? They didn't really have that far they could go. They never wanted to go negative, at least not this Fed. Of course, they did it in Europe. But being at 5% feels pretty good, I think, for them. Because they could do a full basis point cut, 100 basis points, and be down at 4%. That's it. So, yeah, I mean, I think we could be in for, if the economy is good and nothing goes bad, as you say, this could be the new normal for a while. And this is what it was in the late 90s. I remember getting 5% in my my money market, checking account, which was great. And so I agree.
I would just say that the bond market disagrees with you and I on this one.
All right, talk about that. What are you seeing there?
Okay, so when you look at farther out, 2, 3, 4, 7, 10 years out on the yield curve, right, which is basically to say where the market is kind of projecting rates will be. Those are significantly lower than where we are today in the shorter end of the curve and where the Fed is, right? So when you've got a 10-year at like a 3.5, but you have Fed funds at 5%, 5 to 5.25, that tells you that the market believes rates will come down. Right now, I'm not saying it's predicting rates will come down in 10 years, but it's telling you that the market is in a position does not believe rates will stay higher. Otherwise, they wouldn't be out in the market with the way that rates are. So we have this. You've heard us talk about the inverted yield curve many, many, many times. I think we're starting to see that the market is has a pretty strong view that there will be lower rates. And that's why they're down where they are. So I was stalling a little bit to kind of pull the end of the day yield curve up here. So, right, the 5-year is trading at 3.41% yield. That's where its yield is. But when you look at, say, just a 3-month bond, it's at 5.2, 5.3, right? So you've you've got a pretty wide gap there, which is what I was talking about, right? That's telling you the market feels that between now and then, that time frame, rates will come down.
It's interesting when the bond market too, and I don't want to get into the 1 month, 3 month inversion. It was the deepest discount that we've seen going back, I think, to 2000. We talked about that last time you were on. I talked about it a little bit last week. The 1 month, so there's a 28 day bill that was auctioned the 4th. So that's yesterday. That's Thursday as we're recording this on a Friday. And I think the median rate was 5.5. Like 2 weeks ago, Jay, was the 1 month bills were what, 4.2? So that escalated quickly. I haven't had time to look at the auction results. I did look, I pulled up some of the inventory. It looks like today the 1 month bills are right around the 1 month bills or something like 5.3%. So I thought that was interesting.
According to US Treasury Yield Curve.com, the 1 month ended at 5.6, 5.59 today. But you're right. 2 weeks ago, when we were talking about that, the strangeness in the short end of the curve, it was at 3.36. So 3.36 to 5.6. So that's like a 2.3% change in the 1 month rate. That's pretty rare to see in the 1 month bond without a lot of Fed action, right? Not what happened in 2020, but that is rare.
I mean, the 10-year 3 month yield curve inversion, we've talked about this. Cam Harvey created this. He's a professor at Duke. He's written books. 8 out of 8, when the 3 month yield goes above the 10-year, 8 out of the last 8 times, it's been a recession. So, I mean, this is part of it too. Like, if we don't get a recession this time, it feels like the groupthink that's just being thrown out there. Everyone who goes on CNBC right now is, we expect slowdown later in the year. We expect our base case is a recession. It's not a bad recession. And then we have this yield curve inversion. Like, if we don't get a recession, think how many people are going to be wrong on this. It's just interesting to me. I don't know.
Yeah, well, market has a tendency to frustrate the most people, and if we don't actually have a recession, that would be the case. I mean, Derek, you and I have argued that we're in an earnings recession now already, right? So whether that is translated to an economic recession, I guess, is a different story, and then I guess it depends on what part of the market you're looking at, right? I think housing's experiencing, that sector is experiencing a recession. But when we think recession, what do we usually think? Right? Neighbors are losing jobs. People can't sell their houses. Right? Somebody's, fire selling their property. Like that kind of a recession feels a little extreme in this case. So I'm not sure, when we get the definition of are we in a recession or do we end up having one? I guess we'll know when they tell us it's over or they tell us that we're in one. But I mean, there's certain parts of our life that are definitely feeling the pricing crunch, the inflation crunch. So maybe we'll find out this whole time we've been in a recession for the last 2 quarters anyway.
All right. I want to get to our friend, our third member of our panel today, ChatGPT. And so I was a little bit critical last week about it because I asked some questions around list the teams that have never been to a Super Bowl, and they had ones that were. I asked it this time, I said, give examples of years where the Federal Reserve paused rate hikes and the stock market still fell. And the three that it gave us is May of 2000. And it said, the Fed, and they actually gave a description. Fed paused rate hikes after a period of tightening in response to concerns about inflation. But then, of course, we had the tech bubble. 2007, they paused rates shortly before the global financial crisis. So they were raising rates into that. And of course, they were trying to slow down the housing market. And 2015, December of 2015, they paused their rate hikes. However, the stock market began to fall shortly after as concerns about slowing growth. So I don't know. I mean, I just think it's interesting. And like, if you're pausing rates because you think you've kicked inflation, maybe that's one thing. But if you're pausing rates because you think the economy can't handle more rate hikes, that's another thing. In 2000, 2007, 2015, they had to pause their rate hikes. And it's interesting, 2015, we didn't get a recession after 2015, but certainly, how do you say 2000? Is that aught? 2000 and 2007. Yeah. So I don't know. I mean, and then I also asked it, I said, after the Federal Reserve cuts interest rates in response to an economic downturn, how does the market do? And I guess 2020 is really the case where that was so short. It was big, but it was short. They cut rates, and then the markets wound up going up after that. But like 2001, 2008, I mean, markets still went down a little bit more. But that's what ChatGPT told me, Jay.
Well, listen, I would ask Chat GPT about that December 2015 raise. So I don't know if you remember, right? That was the first time they raised rates, and like there was some really long period of time. I know you and I remember 2015, especially the latter half of it, pretty well. They raised in December. I think they just did a one raise and paused. Right? So I wouldn't say that it was really like a series of raises, unless I'm not, remembering that properly. I think it was like a pop and then a little pause, and then they continued to build, over time shortly after that. I do remember early 2016, January started out to be the worst January on record. The first 3 weeks were the worst 3 weeks in the last, I think it was like last 80 years. Of course, it ended up bouncing up, and February was volatile. But look, you remember these things that happen around those periods of time. There was a worry about oil, and there was a worry also about how much high yield debt held oil, and that was going to cause a failure. And then Jamie Dimon came out and said, I think there's a good time to buy high yield. And that was it. It was all over when he came out. You remember all this, I'm sure.
Right.
Yeah. Look, that's so it's an interesting data point. I would dismiss the 2015 one as a pausing in the rate cycle, but I do like the other examples because they happened in advance of a decent market sell-off. So that's something interesting to glean from that.
98 was another one too. That was the Asian contagion, as it was called. And the Fed cut rates between September 98 and January 99. And yeah, I mean, markets definitely stabilized, although that was an interesting one because the S&P, if you look at the S&P returns versus the international returns, they were vastly different. It was like, one was not doing well, one was okay. Yeah, I mean, by the way, 2015, December 2015, they went from 0.25% to a half a point. And then they didn't raise again until December of 2016. And I always said, I said it back then.
It was a one and done, right? So that's good. I'm not totally losing my mind.
Yeah, it was a one and done.
Yeah.
The thing that I remember about then, and maybe they've gotten better about this, but I always thought they should have just said, we're going to raise 25 basis points and we have no plans to raise again until, we're going to give it a long period, 6 months, 7 months to evaluate, of course, unless things change. But the fact that they raised, that kind of spooked the markets a little bit.
Sure.
I don't know.
Don't fight the Fed, right? A Fed that's raising rates is hawkish, and it's tough to get in front of that, as we learned last year. It's for those of you that have never lived through a rate hike cycle.
I still go back to 1994, 1995, and I've talked about this before, and I'm happy to talk about it again because I think it's the most close example to what we have now, the inflation that we had. And the Fed started, 1994, February, they raised from 3% to 3.25%. And then they raised at the March meeting, the April meeting, the May, they kept raising. And then finally, what was this? July of 1995. So they start raising in February of 94. The Fed this time started raising in March of 22. So a month later. And then July 6, 1995, they raised the target rate from 5.5% to 5.75%. And that was where they stopped. And by December of 95, they lowered the Fed funds rate target from 5.5 to 5.25. Like, I got to tell you, I feel like this is the blueprint we're under. And maybe they're done. Maybe they do one more. I don't know. But it's eerily similar, Jay. Just the amount. Now, the size of the raises isn't as much, but the number of raises certainly. I mean, they raised at almost every meeting. I think they raised the off meeting too. That was something Greenspan used to do. I mean, don't you think this is eerily similar?
Yeah, in a lot of ways it is, and I would say the Fed funds futures would tell you that they're expecting the first decline or first cut in September. That's the most probable time that it will occur. That's about a 50% chance that it'll cut once. There's a 25% chance that it'll cut twice. So there's only quick math there. There's only a 25% chance it stays where it is in September. Now that's according to the market, right? So this is another example where those that are placing investments, speculation on the outcome of the bond market are telling us that hey, there's only a 25% chance they stay at this level between now and September. So, and that lines up with your 6 month, almost your 6 month, right? It's May, and then all the way out to, I guess that's only 4.5 months here where the market is projecting it. But to your point, yes, that would mirror the time period much more closely, like you're talking about. Again, I think my feel is unless there's something really bad, follow what they said they're going to do, and it doesn't get cut. But again, that's where the market is a little different, in my opinion. Take that for what it's worth.
Jay, we've also heard that this recession is the most anticipated recession ever, if in fact we do have one or we've had one or anything like that.
Right.
So I asked our friend ChatGPT, I said, what was the most anticipated economic recession ever? It tells me it's difficult to point to a single most anticipated economic recession in history, but they do give us three examples. The Great Recession, 0809, the dot-com bubble, and the oil crisis of 73, 75. And I know that it's been overused. This is the most anticipated recession ever. I think I agree with ChatGPT here that it was pretty clear that we were going to have a recession in 0809. I think it was pretty clear when we had tech stocks, when remember they threw out, earnings don't matter, it's clicks. It doesn't matter. It doesn't matter how much money you make. And we'd look at balance sheets and cash flow statements, be like, actually, the more money this company makes, the more they lose. That's probably not good. I can't say I remember the oil crisis in 73, 75, but I mean, I think it was pretty clear back then, but maybe people weren't so fixated on trying to predict it. And maybe that's the difference, Jay. I don't know.
Well, the dot-com one was really tough to get in front of because eventually you would have been right, but it was rough to be on the bear side of that market with the dot-com explosion that we saw in late 90s, early 2000, right? Like, so it was, yes, eventually you were right, but man, it hurt for a while. And sometimes that happens. I guess it's worth noting that you can be quote unquote early. You almost never time a reversal exactly right, Derek? It's a very difficult thing to do. I will say I did time one trade completely accidentally right in my life. I was this is I wouldn't say it's my best trade. I would say it's the one that I timed something exactly right. I sold WorldCom at $75, and the highest it ever printed was $75. I'm not saying that was my trade. I'm just saying I was in it the day and I traded it at its all-time high. And you got any stories like that where you nailed the exact reversal? By the way, it was probably like 5 shares, right? But you got any stories like that?
Yeah, mine was I shorted rough rice futures. There was a rice shortage, and Kathy, I was at my dentist office, and they had a TV channel on. They sit you in the chair and they watch it. And Kathy Lee Gifford was holding up a bag of rice, saying, "I don't know when it's going to stop. How much rice should we buy? I mean, this thing, it's going to." And they were showing empty store shelves at Costco, and they showed a chart of rough rice. Nobody ever talks about rough rice in the financial media. I mean, I went home from the dentist. I pulled up my commodities trading account. I got rough rice. I actually panicked because I'm like, this thing breaks up above me. So I took profits early. If I would have wrote it all the way down, but it basically looked like the tulip
You
bubble.
nailed the top on
That was
price.
my
Good work.
absolutely nailed it, Jay. Absolutely nailed it. Yeah. Well, Kathy Lee Gifford nailed it, or
Well, she
my
helped you
contrarian
nail it.
sense
How's
that
that sound? Right. So
yeah, Kathy Lee Gifford showing a chart of rough rice futures told me it's time to short rough rice futures.
ask ChatGPT Kathy Lee Gifford's investing success. Has it got any idea there? Is there any way to drop that? Now I'm throwing you a curveball on that one. Oh, I hear him typing there,
You
folks.
hear me typing here.
Yeah,
This will
good.
be this will be exciting.
Yeah, let's see what it says.
I
Her
got to tell you too. Well,
investing accuracy.
it it says, but I am not aware of her being an investment professional or having a significant investment
So
portfolio.
that
So
you pulled that gem out of the dentist chair and you took it for your best trade ever. I gotcha.
it's one of my best trades ever. I got to tell you, Jay. I don't know what your thoughts are. We haven't really talked about this on air, but I think ChatGPT is it's really interesting. I actually signed up for the ChatGPT 4, so I'm paying $20 a month. You can cancel it anytime. I'm going to try that. And I'm learning how to prompt it. But I know, people kind of have fun with it right now. Can you imagine a point where, we subscribe to data, market data, and you and I sometimes will be on the phone and we'll say, I wonder, all the times the market did this and didn't do this or vice versa. And we have, daily data going, that we purchase. Can you imagine when ChatGPT is integrated with some of these data providers and you can just ask it stuff like, oh, tell me all the times the market went down 20% after, 20 days after a Fed meeting and, all these sort of, it starts to get really interesting to me.
I mean, it should be able to backtest for you, right? I mean, that's
Right.
really what's happening there. It's funny you mentioned ChatGPT being integrated into investing. I met with the platform this week. It's not something we're going to use, but the way that it was pitched to me was, look, we'll take your portfolios, we're going to help you rebalance them, and we use AI for commentary. And I was like, wait a minute, using AI for what? And all it was they're using AI to comment on what happened in the portfolio. So it'll comment on here's the rotation of the sectors, here's where you saw money flow, here's the sector that performed the best and the worst, and here's what we changed in your portfolio accordingly. So I thought from a content perspective, it's really it could be interesting for sure to use it as kind of today you could use it as a look back. I was about to ask you, the next time we do a blog update, why don't you see if you feed Chat GPT all of your hypos updates and let's see what it can do.
I think I will do that. And there's some people doing some really interesting things on the writing side.
Yeah.
And it's all about how to prompt it. The thing I will say, Jay, is it's problematic that ChatGPT has to access other data to produce new data. And if I'm a lawyer if I'm in law school, go ahead and focus on ChatGPT copyright infringement. I think there's going to be a bull market for lawyers in AI. I think just my guess, not legal advice, but yeah.
But I think I do think there's a lot of applications in our business, right? So even if it's just your operations, not necessarily the trading aspect of it, right? But I think it's going to be a while before anybody trusts that. But it's to a degree, it's happening right now, right? With all the quants that are out there. I would say though, in like some of the stuff that is more regular and regimented when it comes to say reporting or client reports and those types of things, I do think that it'll have an application there to help in the content creation. And quite frankly, I don't care if it's using our content to recreate new content. I think that's fine.
I'm going to try that. I will certainly do that. It's the other interesting thing. Well, I won't even bring it up. I was going to say the semiconductors, but this has you need a lot of computing power to run this. So I don't know what that means for the semis.
Well, no, AMD just had a huge day yesterday because on Thursday, so it wasn't yesterday when you're listening, because they said they got funding from Microsoft to help them build the new chips. Right? I think AMD was like up 10% on Thursday the 4th. So yeah, the pop in Nvidia over this year has been directly resulted a direct result of their support of AI. So you are absolutely right on that, right? I'm not saying that's the way to go play this. Seems like Nvidia is the solution when anything cool is going on, right? Whether it was crypto, whether it was gaming, computers during the pandemic, and now it seems like ChatGPT, so or AI seems interesting for them. Not a recommendation of Nvidia, by the way. I'm not recommending.
No, it's but you know what this reminds me of too? I don't know if you remember Tim Ferriss. You know who Tim Ferriss is, right?
Yeah, yeah.
Yeah. So Tim Ferriss wrote a book called The 4 Hour Work Week. This is probably 2008ish, somewhere around there. And one of the things he had in there was he hired an overseas personal assistant. And the idea was, he would write down kind of like prompts where he'd say, find this for me or find that, or even restaurant reservations, like a concierge. This is really similar to that. And I could see this being integrated. Like, could you imagine if they integrated this to what's the restaurant site? Like Open Table,
Yeah, open table, sure.
where you can just, yeah, can you imagine? You just tell ChatGPT, find me an Italian restaurant in New York City between this time and this time with this price range. And I mean, and even just like think about the research stuff. Like if you or I wanted to do a lot of research with market data, and we could maybe ask ChatGPT the same thing as opposed to paying somebody, hey, go test this or go research it. It's really interesting to me.
Yeah, it could make a reservation for us at Dorsia. Oh, that's an American Psycho reference, Dorsia. Sorry, I watched it recently again. It's been a while.
All right. Well, speaking of recommendations, you saw a movie or have you seen any movies lately you want to talk about?
I did. I'm going to disappoint a few people. I saw Guardians of the Galaxy 3 on opening night, and I'm going to tell you, it wasn't good. I didn't like it at all. Actually, one point was like if I was sitting in my living room, I would have changed the channel. Yeah, not a fan.
Really?
Sorry, Marvel, not my fave. And I like Guardians.
Are we going to cause the stock to crash with your displeased of? Are they still public? Is Marvel? No. Who owns Marvel?
No, they're owned by Disney.
Oh, that's right.
Yeah,
that's right.
Yeah, sell Disney. I'm kidding.
No, not a recommendation. I never got into all those movies. It wasn't until my son started liking them that I ever saw them. It was I can tell this story, Jay. I'd seen what is that? Endgame. Who's that?
Yeah.
Movie Endgame, right?
Yeah, that was a good
Yeah, so
one.
I saw it, and I don't want to no spoilers, but it was just funny because apparently after all these movies, which I'd never seen any of them, they all got together, and then I remember Michael Douglas walks in. I'm like, what is Michael Douglas doing here? And I had no idea he'd been in one of the other movies. So
Yeah, Hank Pym. You got to know Michael Douglas from the Ant-Man series in there. Yes, of course. The Ant-Mans were not bad at all. But yeah, you gotta look. There's a lot. Like Robert Redford is in those. Like they've got a lot of actors have just found their way into the Marvel universe. This one wasn't great. Sorry to say it.
all right.
Please prove me wrong. Please comment back and prove me wrong if you loved it.
Guardians of the Galaxy is getting a was it 2 thumbs down? Is that the Siskel and Ebert thing?
Yeah, I almost yelled out in the movie, "This is boring," but there were all the people
Wow.
dressed in the Guardians garb in the movie theater. I thought maybe I shouldn't cause a riot. Really, I'm really negative on this one. My apologies.
Yeah, you are. You are. Was it better or worse than Ishtar?
Same.
Some people in the audience will get that reference.
Yeah, same as Ishtar.
Who is that? Warren Beatty and Dustin Hoffman, I think, right?
Stuck in a desert.
Wasn't that who was in that? Yep. All right. I got nothing this week except you should be watching the hockey playoffs. And Jay, I know you got to get some hockey fever down there in Florida. The Florida Panthers upset the Boston Bruins, and they're up 2-0 against the Toronto Maple Leafs.
Well, we have a hockey team in Florida.
You have 2 hockey teams in Florida. You have the Tampa Bay Lightning, and you have the Florida Panthers. They're
Wow.
in Sunrise, Florida, which is
amazing. I'm kidding. I knew that.
Where's Sunrise?
It's
Fort Lauderdale?
Yeah. That area.
Okay.
Yep.
So yeah, you got to get to a game. I mean, they were the last team to get in the playoffs, and they beat the Bruins, who had the most regular season points ever in the NHL in over like 100 years. So they upset them, and then the Maple Leafs have been snake bitten, but in the playoffs they haven't gotten out of the first round. They get out of the first round, they're already down 2-0. So hockey playoffs are great, and playoff hockey, especially when it goes to overtime, because they don't do any commercials. It's just they just keep going, because otherwise the games would take forever. So that's my recommendation. ESPN, TNT, TBS. Look it up. There you go, Jay.
Could you ask ChatGPT the most watched show on HBO? Let's get a recommendation from ChatGPT. I've prompted that.
All right, most watched show on HBO current. Well, I can't say currently, because doesn't the training data only go up through 22?
Yeah. So I'm not. Yeah, I'm guessing Sopranos.
All right. Well, it says, hey, I'm an AI language model. I don't have access to real time data. But as of the end of 2022, Game of Thrones was the most watched show on HBO.
Whoa. All right. Listen, I watched that one too. And we've recommended that multiple times and referenced it multiple times. But anyway, there you go. ChatGPT gives you a recommendation.
I'll ask you for a list. So this is how I'm thinking. So Sopranos was number 2, Sex and the City 3, The Wire, True Blood, Westworld, and then Entourage was 10, by the way. But yeah, so that's interesting.
Fun with ChatGPT. Good work.
So I don't know where Succession is in this, but was Succession, this is season 4. I think it was around in 21, wasn't it? No, it may not have. No, it was. It definitely was.
It definitely was. Definitely was.
All right. Well, I think we'll leave it there, Jay. We've our friend, but now we get to put ChatGPT in the title, so that seems to people like that apparently.
Fun stuff. We'll figure out a real use for it.
It's like the .com in the 2000s, Jay. Remember, like if you had a bookstore, just call it your bookstore.com, and immediately you had a 50 billion valuation, right?
I remember when Clorox launched Clorox.com, and they sell bleach, and boom, the stock went through the roof. I remember.
I mean, pets.com, remember that one?
Oh, well, that's the poster child, of course. Yes.
That was the sock puppet. That was they spent like $1 million on a Super Bowl ad, and they IPO'd, I think, in the spring of 2000, and they were bankrupt and delisted, I think, by the end of the year. So definitely the poster child.
They were just early. Think about like Chewy and all the companies now that support your pets. Pets.com was just early.
They were. So, all right. So real quick, I went back and I looked at their offering docs on their IPO.
Yeah.
What is that called? The S4? S3? What is that?
I don't know. I knew it when I took the test.
Yeah, it's the S&amp. So I went back and looked at it, and it was the risk of the business. So they were headquartered in the San Francisco area. They had one warehouse, and one of the risks was there'd be an earthquake. And their distribution their distribution center would go down. So they literally had one distribution center in Northern California. The other was that maybe people won't adopt the internet as much as we think. That was one of them as well. And they didn't have earthquake insurance. So if there was an earthquake and they had damage. So it was just really fascinating to go back and look through the offering docs. And they had never made money in I think 10 years of being a business up until the IPO. I don't think they ever made money. So there you have it, Jay.
There you have it, ladies and gentlemen. Derek Moore, Professor Derek, reviewing offering docs at pets.com. Derek, no one's going to get that kind of content anywhere on the internet. Good work. That's great stuff.
Yes, absolutely. All right, Jay, we've beat this up enough. We'll talk to ChatGPT next week. Thanks again, Jay.
You got it.